This is Trepp Wire with a special podcast, The Economic Impact of COVID-19. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. And joining us today is Donald Sheets, Managing Director of Broadshore Capital Partners, responsible for leading the firm's loan acquisition platform and running their New York office. Don serves as portfolio manager for Broadshore's Special Situations Debt Group and provides oversight of proprietary research, investment sourcing, structuring, and the resolution of non-traditional and high-yield commercial real estate credit investments. Welcome, Don.
Thank you, Martha. Thanks, Manus and Joe, for having me today. Quite exciting to continue building on this podcast series that's been evolving through this pandemic, and hopefully filling some pretty big shoes over the last several weeks of these prior podcasts. Glad to be here.
Wow, that's really kind, isn't it? If you don't mind, Don, give us a quick overview of your background in the industry.
Yeah, sure. I mean, most people, interestingly enough, when they come into bankruptcies and restructurings and workouts, kind of stumble upon it. And I would say that that was certainly how I approached the business about 20 or so years ago through workouts and restructurings. Started first on the borrower side, doing some blocking and tackling through some legacy investments at Carlyle, and then eventually transitioned over onto the principal side and began this business through an investing program and effectively targeting mortgage debt from banks and servicers and life cos at a discounted basis, and then having a team to work them out. And so that's what I've been focused on for the last few decades.
So obviously with COVID-19, everyone's trying to assess the severity of the downturn and the outlook for the recovery. What's your take on that?
Wow. Well, there certainly seems to be this disconnect between the flashing Bloomberg screen, at least for equity markets and even for high yield markets, and what we're seeing on the street. So the Main Street, Wall Street disconnect feels pretty significant today in terms of expectation differences. So my sense is that one side probably is more right than the other, and it's unclear which of those two might be right. My sense, though, is that Main Street has a fair amount to go.
Don, the various stimulus packages have had the effect to seemingly slow things down. For the Main Street side, we've put cash in people's pockets. There's been unemployment benefits that they're talking about extending at this point. There's now talk about potentially a hotel or a retail bailout or a CMBS bailout. How has that slowed down the process of price discovery, and how has that changed your perception as to how quickly or how slowly this pandemic shakeout might take place?
It's a great question, and we're certainly seeing lodging paper come through the markets as a data point. We're not seeing that much retail yet, interestingly enough, even though the pay rates on retail after hotel are the most impacted, particularly in the tenant side. And it's been what I would consider fairly, maybe not chaotic, but less than favorable market where a bid-ask spread on secondary debt, paper right now is either wide or what we've seen is things being brought to market for some, price temperature taking, and then being taken away from the market. So it's actually difficult for us right now to assess what the conditions are in terms of that bid-ask and what those expectations are for pricing, because not much is really trading in the secondary debt whole loan market. Obviously in the CMBS market, you are seeing prints, you're seeing single asset, single borrower deals that are impacted, and you are seeing trades and levels around those bonds. But billions of dollars have been brought to market on whole loans, and a lot of it is not necessarily transacting. And it's led to a pretty fatigued market. getting into this summer on the secondary debt side. So it's unclear to us really where clearing levels are for whole loan mortgages.
Do you think that some of that no trade activity is happening because of the bids that they're getting and they're just too low to even do the transaction? Or do you think it's, like you said, temperature taking, and also the specter of even more potential bailouts and, Federal Reserve programs that could potentially help some of these borrowers? And they're thinking, if we could just hold out another month, or lenders, I should say, if we should just hold out another month, we might be able to be made whole in the long run.
Yeah, I think it's a mix of a few things. One was a fairly quick reaction to the March sell-off in the credit markets and the equity markets, where warehouse lines and repo lines for private debt funds and mortgage REITs predominantly were in serious jeopardy, right? And we saw a few large private debt funds get recapitalized in pretty short order. Ladder Capital, TPG, others, where a large slug of paper from some of those entities as well as some of their peers came out because there was pressure from the warehouse lines and the repo lines. In time, it appears that some of those private debt funds restructured those lines, which probably required some level of rebalancing or pay down, as well as some kind of covenant holidays. So there was relief at one level, which was serving as the catalyst. And so a retreat, even if they brought loans to market, they were simultaneously working with those warehouse lines and repo lenders, and may have then reached terms and then therefore retracted the loan sale. In other situations, we're certainly seeing a big acceptance toward forbearance, right? Where even the agencies, Fannie and Freddie, granting express forbearance on multifamily, which translated over, I think, into mentalities for other lenders. You're seeing the OCC, the Fed, and the FDIC that are accepting forbearance right now and actually promoting forbearance for regulated institutions. So you've got a little bit of an institutionalized wait and see right now on parts of the market. And then you've got some situations where on, for instance, hotel loans, there is just an agreed market construct that income, if there is any free cash flow coming from the asset, is unclear. All parties are agreeing to forbear around those for the most part right now. And this price discovery that's taking place could very well be that mix of temperature checking, like we were mentioning before, which really begins exercising the market. There can only be so much tolerance for crying wolf in the loan sale market before participants effectively either stop attending, stop bidding, or otherwise look for other opportunities. And there runs a risk of there being an adverse impact to liquidity in the secondary loan markets because there's been such a burn that's been happening the second and third quarter here.
Just to make sure I heard that right, in the March and April period, we saw a wave of forced selling, if you will, warehouse lines and REIT sellers. Has some of the recent selling been from guys that are not under the gun, insurance companies and others that are just trying to raise cash because they think things will get worse?
Yeah, we are seeing a few different types of sellers out there. And in fact, we have right now, we're in advanced stages of diligence on a loan from a life insurance company on an asset that's a value add office building. Every tenant right now is current, so it's not an issue of tenants paying. And it likely would have been a loan sale regardless of what's been happening in the COVID environment because the borrower's business plan is taking a little longer than expected and has been effectively carrying this loan because it's right now not at a full DSCR coverage and a bit of a drag on the lender's balance sheet. Certainly now much closer in the lender's purview because there's a maturity coming up imminently, and as an alternative to a workout, they naturally explore loan sales. And so we, as a tangible example, yes, on the insurance code front, but primarily what's been coming through the market has been private debt funds, in mortgage REITs the last few months.
So we've had the pleasure of knowing Don for quite a while. I always had touted in Trepp Wire that his segments at CREFC had been among the best. He would often be part of the Hydra conference down there, which was usually closed to the press, so I couldn't give out any details, but I do believe that the statute of limitation is now over, so I could talk about it freely. Back in 2016, you were an early predictor of low oil prices flummoxing the market. We had seen a sell-off in equities in 2015, late 2015. And your prediction at the time was to see oil prices lead to energy defaults leading to loan spread expansion, and that gravitational pull landing on CMBS, which in fact happened. There was a lot of volatility in Q1 and Q2 in CMBS, and that market really shut down. So that was quite a prediction, and one that you really nailed in terms of its depth of problem and its timeliness. So by long-winded way of my next question, we are now facing an office market with a lot of opacity, right? Where nobody really knows what the next shoe to drop is. You were talking about doing an office deal right now with a non-stressed buyer. How do you handicap this right now in terms of future demand, future roll rates, loss of drop in asking rates between pre and post COVID? Give us a sense of how you look at this type of asset now, with transparency being at a minimum.
Yeah, and office being one of the asset classes where you at least have some stickiness of rent roll, right? And so one positive attribute of a deal like this is that there is some credit tenancy in place, and it's contractual for a period of time, right? A little different than some asset classes, let's say like retail, where even if you do have a rent roll in place, what's the durability of it, and is it defensible against bankruptcies and restructurings? We liked a bit of the aspect of some credit tenancy. There still is vacancy in this asset. There's still 30% plus leasing to go. But at the basis we were looking at, we felt pretty compelled. We were pretty sober on only leasing up part of that vacancy, leaving, at least 15 to 18% of the building is permanently dark, like a permanent discount, and being pleasantly surprised later if that's not the case. Baking in what we thought were fairly conservative TIs, leasing commissions, inducements, being measured on what we thought that lease up timing would look like. And we had a little bit of extra edge here in the sense that Broadshore previously had owned an office building adjacent to this office building in the same market. And so we had some good intel from the ground in terms of the bricks and what was happening within this micro market leasing environment. We also saw, and this is kind of a theme that we use a lot in our investing style, a sponsor that had stuck with the asset, right? And that does not necessarily mean they will continue sticking with an asset, but they had invested, in this asset clearly many years ago when they acquired it. They had refinanced it, and they've been investing significant TI dollars in the last 2 to 3 years. So there's a vested interest for them to stick with it to some point of be rational. However, we never would hang our hat on that, and would realize that just like us, you can, look at good dollars after bad and make an analysis of whether you continue sticking with the situation. But when we go and buy a mortgage, it tends to then add a degree of optionality where this seller, which was a life insurance company, who has a basis that was cast many years ago, it might have internal risk parameters, has a different mindset in terms of that optionality than what we might be able to do with the borrower. And so we kind of come in at a new reset basis. We might be able to restructure something that a life insurance company, or particularly a bank or a servicer, can't do, which is perhaps having some equity participation or some other attributes to that restructuring that others can't do because they're either regulated or have REMIC rules, or there's conformance within a portfolio that this would not conform to for risk weightings. And so that opens some flexibility for us and will tend to generate the types of yields that we like. But to the larger question, Manus, there's a big question mark out there in terms of underwriting. And that's what you're asking is, how do you get convicted around today's environment? From my perspective, lodging transactions is primarily a basis play, right? We could try to do 6, 12, 24, and 36-month forecasts. But at the risk of sounding a little trite, it is a complete speculation if you're going to take those cash flow projections, because none of us knows what the course of travel is going to look like. There certainly is a lot more supply in lodging than people may have fully realized now that we see this closure activity and then what has to get absorbed. And a lot of supply that's still coming online. There are a lot of hotel construction loans that are midstream right now and still working toward an opening. So those assets, for me, feel like it's just what per key feels like a good basis. And certainly you'll run some projections around cash flows, but it's not going to be any kind of discounted cash flow analysis. It's really just going to be a basis play. Retail is going to be a wild card of what we probably would see as some binary outcomes and probably faces more of an obsolescence issue with the collateral and what that looks like. So each of these asset classes have some nuances, but it's complicated for sure.
So Don, thanks again for coming on. Nice to talk with you. Since I was a young pup at Trepp, I've been reading Sheets, and I'm very glad that you brought it back recently, and I'm looking forward to all the future installments. For anyone that doesn't read Sheets, it's second only to Trepp Wire in must-read rankings in the CMBS and CRE markets. So definitely reach out to us and we can put you in touch with Don. But anyway, kind of a interesting move on your part, mid-pandemic, moving from New York to LA. Give us a vibe check. I've been asking all of our guests who are in different locations, either in the US or abroad, what are you seeing out there in terms of people's responses to this whole pandemic thing, the quarantine, and just general, are you surfing every day, things like that?
I wish. This old body out there in the waves, hardly. First, Joe, thank you for the shout out on Sheets. It's been fun. I've been doing it now for nearly, 15 years, and it's kind of taken on a life of its own. I did take a small hiatus a couple years ago because I just got too darn busy and it remained on the list. And I did pick it back up as a resolution. So it is back in kind of fierce circulation. Happy to add anyone who's interested so they can get in touch with you guys to figure out how to get that done. It's easy. On the cross-country move, wow. It was interesting because I, in early March, like many, did take a safety valve and left Manhattan for what I thought was going to be a couple weeks because none of us really knew how long it was going to last. And boy, did that suitcase take a beating. Was out of the city for several weeks and then eventually drove across the country. I'll put an asterisk on it, in a VW Beetle, no less. Okay. And this was early April when this happened, when everyone was still very much on lockdown, and it was really interesting to see. And I still don't know if I have a full conclusion of it, but it was certainly a varied approach driving across the country in that snapshot of time in areas where it was not necessarily so easy to say red state, blue state, urban, rural, as a distinction of how people were taking it. The entire drive through the state of Pennsylvania, and in early April, there's almost a blizzard going on through Scranton. I remember that. I'll never forget that. But everyone driving, not even just outside of their cars, had masks on. I would say a day later, when I was going through rural Indiana, very similar demographic, right? not a mask to be found, no one social distancing, no Purell anywhere. Pennsylvania, to get out and gas your car, you had to have a mask on by statute. In Indiana, it was the Wild West. I didn't see one mask, right? And again, we're not talking about drastically. Those are both quote unquote red states, right? And again, a similar demographic. Driving through Columbus, Ohio, city was dark. Certainly felt a bit like Manhattan, where it was difficult to find lodging in that evening, and not a piece of traffic to be found. Next day, driving through St. Louis, comparable Midwest city, there was rush hour, right? It was intriguing, both blue cities, right? Getting through the Ozarks, again, as though nothing was happening. Hitting Amarillo, Texas, masks galore, wouldn't have thought, right? So it was, when I got to Tucson, kind of a mixed bag of how people were taking it. I now certainly see with the uptick in virus, why Arizona has had the backlash. I was in Tucson for several weeks, and it was not necessarily being taken all that seriously. In fact, I heard from a few people who were under the view that because of the temperature, it wouldn't spread. And so therefore they weren't really taking it seriously. And one of them was a medical professional that I'd gone to see. So it was very interesting. But I think here in LA, we're now on a phase 1 lockdown. It's retrenched back, and this city's taking it pretty darn seriously. Everyone has a mask on, and social distancing is being taken pretty seriously. I have not tapped on the brakes on a freeway here since I've been here. It's been remarkable.
It sounds like a Glenn Campbell song. By the time I get to Phoenix, I always like Glenn Campbell.
Thinking Fast Car by Tracy Chapman.
Well, it goes to my question though. When you compare a city like New York, which I personally think will have a really tough slog coming back for several reasons, versus one like St. Louis, where you said there was rush hour. Do you look at this from an investing point of view and say St. Louis is going to have a smaller dip than New York, and does that influence your potential purchases? Or do you think that it's a case where St. Louis just hasn't hit the wave yet, and once it does, it'll be just like New York?
It's interesting because I think if we're going to use St. Louis as the kind of anecdote, I think it was the full state of Florida, the full state of Texas, the full state of Arizona that thought they were exempt from what was happening. One, based on temperature, and people thinking that because they don't ride the subway, or that they're kind of suburban in nature, they're not going to be affected by this. And it took a little while for that wave to really come through. Because people it was on the TV screen, and then it really, really hit. So in terms of affecting our investing style, it's too much of a wild card to try to make a call on are the St. Louis's versus the Columbuses of the world going to make it back sooner or later. It's really going to come down to just, do we have some resiliency on cash flow? Do we believe there's obsolescence or not of the asset? And then when we look at buying debt, what's the borrower doing? Do we have optionality with this borrower? Do they have skin in the game still? Would they put more skin in the game potentially? And an underlying investment philosophy of, does this collateral have a reason to exist? And that's particularly relevant today. And then the last prong to that is not just the reason to exist today, but a reason to exist 5 to 7 years out, because we'll need a takeout lender to take us out, and that takeout lender needs to believe in the viability of the asset as well.
Right, makes sense. Does this collateral have a reason to exist? I like that a lot. Might have to add that as one of our indices that we track.
So existential.
Does anything have any reason for anything?
Albert Camus book.
It's all living. Yeah, I don't know.
So Don, let me ask, when you're, I guess looking for investment opportunities, do you have a specific kind of mandate, or are you kind of broad national opportunistic, all property types, or are there, specific areas that you're interested in versus, or specific areas you're avoiding?
Yeah, we tend to have to be reactive because we respond to what the market's offering to us. And so that's one first lens that we look at is we might have a view that, West Coast office, like go after it. Well, that requires a lot of sellers to have to be selling paper for West Coast office. So we therefore have to be reactive, which means that we have to be open on what we're looking at. So we don't believe that everything has a price. There's one cut of investor that believes that at a price anything can clear, and they could be compelled to invest. From our perspective, we do have to have a degree of conviction that there's good return on invested capital, but also good ROT, or return on time. And there can be a lot of investing situations in our space that are a void or quicksand of time and effort. That maybe you got it at X cents on the dollar, but you spent a whole lot of mind space and a whole lot of effort to make something happen. Not saying that what we do for a living doesn't take that amount of effort, but sometimes writing a $10 million or $20 million check and spending inordinate amounts of energy and time and taking on what is probably much greater risk than your investors might appreciate are deals that we're happy to pass on. So within that vein, we will look at assets that we can get a good view of valuation through comps, through cash flow analysis, understanding the rent roll, and running our own sensitivities and forward projections of cash flows as though we owned the asset. So that would strip away non-income producing assets. So we're not a player on land. We're not a player in single family residential, mostly for the political overlay there, as well as the ROT aspect. We occasionally will play on construction loans. It depends on what stage of construction, what kind of guarantees are in place. So it's very situation specific. In esoteric asset classes like golf courses or marinas or churches, you see all of this in the loan sale spectrum. We're not a player because of those fundamentals I mentioned of cash flow and valuation. I'm also not a fan of necessarily working out a religious loan. Some of these church loan portfolios that come out, if it's us versus God, I'm not quite sure what side we should be taking. So it becomes a little hazy on those, but we occasionally see these church loans in pass. But we do focus absolutely on lodging, retail, office, multifamily, industrial. We will look at senior housing, again, situation specific, and some student housing. But even within the universe of distressed buyers, there's a subset of us who are very, very reticent on retail, understandably, but it is what I think is going to be a fundamentally mispriced, misunderstood segment, more so than lodging this cycle when it continues to come through.
There have been some guys that have done, they've made some bets, at least on the retail, on the shopping mall side, but they do seem to be getting it for a basis of about 10 cents on the dollar, which seems to be the kind of economic trade on the equity that is, that you need to see to make work, right, at this level, considering where vacancies are and occupancies. But turning to the political overlay, where you last referred to in terms of staying away from single family rental and other things. We've asked this of other guests on the show. With each crisis that comes through, from 9/11 to the great financial crisis and so forth, there are some winners and losers, and there's a change of regulation and the entire landscape. Give us a sense of, are there winners and losers to be had in this market in terms of lending market share? Will there be more regulation coming out of Washington as a result of this? And to just completely fill your mind with too many things to think of in one question, will we see a bailout for hotel owners?
Wow, it's a lot. This may sound a little cheeky, but I tend to view the universe a little bit less of winning and losing, and more of, can the pie grow or shrink? The winning and losing tends to be a little bit of a binary kind of fixed pie situation. And in this last cycle, it was interesting because in the commercial real estate space, you saw certainly an entrance of new players in the private debt landscape that did not exist to the degree they existed pre-GFC, and the pie grew. It wasn't necessarily that these private debt shops took the fixed amount away from banks or CMBS. The overall pie of lending actually increased. Now, loan to values also increased, right? So if you start looking at share, there was certainly some shifting in share between these different lenders. And I think the securitized markets ultimately took less share, clearly post GFC. And if there was a quote unquote loser in the spectrum, it was probably CMBS, overall, maybe a little bit of marginal quote unquote loss to the banks. But the banks effectively made it up because they provided the warehouse and repo lines to the private debt funds. And so their pie grew. Overall, they became much more active participants in the commercial real estate lending environment. You had a crowding out as well from the agencies. Fannie and Freddie in multi, ballooned after GFC. They were certainly active pre-GFC, but were massive after the GFC for that one asset class. So I think when we are entering this new era of where regulation might be, it's a little unclear. No surprise, because I think the state of flux in Congress, as well as with the presidency, it's not really clear what direction policy is going to take right now. And a bailout of lodging, it would be really remarkable, right? I think the Treasury Secretary has, at least from what I've seen, made it clear that commercial real estate is not necessarily going to be a preferred participant in a lot of the bailout activity. But I will just say, without trying to sound political, but as an apolitical taxpayer, bailing out lodging would have me concerned. It's a private business, it's a private enterprise. You had very sophisticated lenders and capital markets participants, and you had very sophisticated borrowers, and you have assets that are not people's homes. And so there are thousands and thousands of jobs involved here, absolutely. And there are ways to address that, potentially without bailing out the asset class. It might be through policy perspectives on employment, right? Not necessarily with bailing out lenders or borrowers.
So, yeah, and it's a slippery slope, right? You bail out borrowers this time. What happens next time? You have to bail them out again. And how do you, all of a sudden, the market can't price in credit risk or anything really, or find a price. So you mentioned some of the other asset classes too, and multifamily is one that obviously everybody is very interested in. It's been the hot commodity for the last 10 years. You mentioned Fannie and Freddie have taken up a huge portion of that market. And we talked earlier about, they were, forbearance in a box. They came out very quickly early on in this pandemic and offered forbearances, 90-day forbearances and so on. Do you foresee there being distressed opportunity in the multifamily market at some point? Or do you think there's just so much capital and so much willingness to extend and pretend that there won't be? In all these cycles, every asset class tends to get affected. So we certainly should expect there to be multifamily paper that trades. We've seen actually a lot of multifamily new origination paper, and I'll use that word, call it 18 months and less in terms of seasoning, out to bid to the market, not for distressed prices, but at slight discounts to par, right? These might be 2 cents of discount to par, which can be interesting to some players. And so we've seen an uptick of multifamily paper out in the market right now. And
Part of that is because the lenders who are selling this are not, obviously it's not agency debt, right? These are private debt funds or other institutions. Collections remain anywhere from mid 80s to mid 90s typically in some of these assets. And so you do have a question mark over what the bad debt is going to look like. I think that there are some participants in the market who are concerned with the potential legislation of rent control in markets where there was a large run-up in rents, coupled with high unemployment rates. And what might be an asset class that, because they are technically people's homes, is going to be subject to some of what we saw during the GFC in single-family residential. And so there is a bit of a wild card still to play on multifamily, particularly for existing rent-controlled multifamily, and for multifamily that might be in markets subject to potential rent control or governance that could influence collections.
So I know that you also have some direct experience in a subset of the multifamily market, which is student housing. Give us your take on, expectations for student housing, especially in the areas where, the shutdowns are still in place, New York City and, other major metropolitan areas.
Yeah, it's quite unique because many universities are taking it upon themselves to come up with their own, policy for what the fall, spring terms are going to look like. So I do serve on the board of a group in New York it's the largest student housing operator in the city. And so we've got some good visibility of what's happening. We've got obviously large universities, which are some of our clients and tenants, all the way down to, for-profit colleges and small liberal arts institutions. And what we saw this summer was remarkable. There was barely anyone that came to Manhattan for internships. No surprise, probably to most listening. And virtually no in-person learning in New York. So immediate drop-off in Manhattan for student housing. If you do not have kind of contractual floors in place with institutions and we're leasing it to individual students, those beds. Even within New York, Columbia is taking a bit of a different approach than NYU. CUNY is taking a different approach. It's primarily commuter-based versus resident-based, although they do have a fair amount of resident population at Baruch and some of their branches. And then you look outside regionally, you have institutions like, in the Southeast Athletic Conference who are hustling to get students back to campus because they need to keep their athletics going. And there's a real concern around faculty with some of those decisions. And so it's a bit of the Wild West where, we right now clearly have states that are taking their own approaches, and then sometimes, localities. I mean, look at Atlanta versus Georgia right now, right? The governor versus the mayor are having a big standoff. And a substantial amount of that state's population is Metro Atlanta, right? So it's interesting what that power standoff is looking like. At many, colleges and universities, it's a very patchwork decision process that's getting made. And even within universities, you're having some schools take their own approaches. At Harvard, for instance, they're deferring to the various underlying schools what they're going to do. And so to get back to the question on student housing, it's, again, clearly a wild card. I'm not privy to what the public companies are doing in terms of giving students out clauses. I certainly would be asking that question if I was on an earnings call. Maybe they're at, high 80s in terms of lease rates, but are those no longer 9-month or 12-month terms? Are those month-to-month terms? Have they relaxed covenants or guarantors? Don't know, right? Would be useful to see that, because if I'm a student signing up for a 12-month obligation with mom or dad on the hook, that's a pretty big thing to digest when I don't know if I'm going to be in school in a month and a half. And what kind of inducements being offered, I just don't know what's happening in the private market for that. And we're exploring those options right now in Manhattan with EHS to experiment with what's tolerable in the market.
As somebody who's in the process of putting number 5 through college, I could tell you that it's only the parents that are concerned about that 12-month lease. Right? you said the parents and the children. It's not the children that are concerned about those terms or conditions, Don. It's a much narrower focus.
I can verify that. That is true. Don, you are a professor as well as many of your other accomplishments. What's been your personal experience on that side?
Yeah, so despite me being bi-coastal, I'm still very much a New Yorker and view myself as not ever leaving New York. So I do have my faculty appointment still at NYU and Columbia. And in fact, taught a class 100% virtual that just ended through SHAC at NYU, half semester elective on distressed investing. And I surprised myself. I would say that, this old dog learned a couple new tricks in terms of how to, do virtual teaching on the fly. With some support, mind you. And I would say that it is certainly, if you're able to run a classroom in person, you can find creative ways to run a classroom virtually. Not all find that same level of ease. And I think, frankly, if I'm a student paying top dollar for, at a great public college or a great private college, and am forced into a dynamic that is not residential, meaning on campus, and that whole experience, maybe I have tolerance to do that for a semester to kind of see what happens and continue my studies on track and not lose my connection to my sophomore or junior peers. And, and by the way, what other options do I have for this fall anyway? Becomes a lot more complicated in spring if it still is a virtual or hybrid environment. And I'm not seeing a lot of colleges necessarily giving price breaks or accommodations around what is a compromised experience. They have a very large fixed expense base that they can't change based on what's going on. Whether they're having students sit in a classroom or sit at home, it's marginal in terms of the expense savings. And so it is difficult for them to pass anything through. And so we are seeing, so I'm seeing it from the faculty side, both at NYU and Columbia, as well as, through a lot of the student housing that I touch in New York. I've got touch points up to a few other institutions that I occasionally teach with. And I would say that right now, the higher education landscape is very stressed. There's a large concern over what does fall and spring look like, not just from what's the product offering, but effectively what's the revenue going to look like. And when you can't do programs like executive education and other publishing, which are large profit centers to even institutions like Stanford, Yale, Harvard, right? They are very much on capital freeze programs, faculty freeze, everything, right? And they were probably, I would say, in April at that point. So you have a lot of institutions that had multi-billion-dollar plans for the next several years of capital improvements, new buildings, enhancements to existing programs, new dorms. All of that is completely frozen today. And so when we think about the effects of COVID, it's not just what does fall and spring look like at these colleges. They have completely retrenched, like in the GFC, on a lot of spending. And these universities are big parts of GDP, and we think about those ripples, right? And so, higher ed has a big ripple effect that still is going to go through the system. And it's not one where if the vaccine happens in January, it's all systems go, so it's going to be quite intriguing.
So, Don, let me just, you must teach grad students, because I didn't have such a great experience teaching undergrads, but then again, we had to switch halfway through the semester from in-person to online, and it wasn't their fault, I don't think. I think I get a lot of energy from being in the room with the students and having the conversations, and I think I was, after 8 hours of Zooms for work, doing another hour and a half of me talking on a Zoom, I think I wore them out. I still got pretty good comments back from the students, but my favorite one, which I mentioned on this podcast weeks ago, was just in quotes, YouTube is better.
Ouch.
So watch out for those disgruntled Zoomers who are angry at me for using GoToMeeting and not Zoom. I will also say that you are officially invited to our cross-country road trip because you have done it already. When we single-handedly support all of the Econo lodges and the Motel 6s along the way. But we surely were going to need a different type of car, I think.
Game on. Yeah, Route 66, you'll have to hit some of the diners. You're not going to hit much traffic, so that'll be nice. But it'll be your own Griswold family vacation.
That's right.
On to Wally World. So with that, we'll close this special podcast. Thank you to our guest, Don. Thanks to our producer, Keegan St. Ange. Join us later this week as we look at what happened during the week. And if you have a question, send us an email at podcast@trepp.com. Until then, visit trepp.com for more info and subscribe to the Trepp Wire podcast with your favorite provider. Thank you as always for listening and stay well.
All right.